Hey everyone, welcome back to Corporate Decoder, the place where we dissect corporate filing so you don't have to. Today we're diving into Urban-Gro's latest quarterly report, and let me tell you, it's a bit like a garden that needs some serious weeding. We will get into why soon, but let's just say it involves losses, debts, and a market that just isn't blooming right now. Buckle up, because this could get bumpy. Urban-Gro just released their report, also called Form 10Q, for the period ending in June. It's like their report card for how the company did over the last 3 months from April to June. Urban-Gro, they're in the business of helping people grow things indoors. Think of them as the architects, engineers, and construction managers for indoor farms, also called controlled environment agriculture. This includes cannabis, leafy greens, and plant-based medicines. Basically, they design and build indoor farms and also provide services. Now, here's where it gets a bit tricky. The report points out something that should make investors pay attention. It says that the company has had net losses for multiple consecutive years. This means they're spending more money than they're making, and that's a big deal, and they have negative cash flow. To put it simply, they're running out of money. This raises a big question: can Urban-Gro stay in business? It casts substantial doubt about its ability to continue as a going concern. The company said that it has decreased its number of employees, also called headcount, and operating expenses. Operating expenses is the amount of money it costs to run a business. They hope these actions will expedite the company's path to making cash flow positive results. In other words, their hope is to become profitable. The company says if necessary, they will seek to raise capital. They may also try to get debt financing, which is borrowing money. There is no guarantee that will happen. The company's management believes that the recent actions alleviate any doubt about the company's operations and meeting its financial obligations for at least the next year. So, where is Urban-Gro making their money? Their sales come from different segments. They have equipment systems, revenue. Think of them as sales from providing equipment for these indoor farms, along with services revenue such as the design work and construction design build for actually building these indoor farms. The company does business in two main sectors: the controlled environment agriculture, or CEA, which focuses on cannabis and food production, and the commercial sector, which includes businesses and government projects. Let's break down the revenue numbers in the 3 months ending in June. Equipment systems brought in about $3.4 million, which was down from last year. Services generated $2.4 million, also down from last year. Construction design build was a bright spot at $12 million. More than last year, all other revenues were immaterial. The commercial side of the business is far behind the CEA. Now, for the 6 months ending in June, equipment systems brought in $5.9 million, also down from last year. Services were about $5.5 million, also down from last year. Construction design build was a bright spot at over $21.7 million, more than last year. Other revenues were immaterial. Looking at the percentage breakdown, the CEA sector made up about 56% of the revenue, while the commercial sector made up the remaining 44%. Sometimes the company will invoice a customer for long-term construction design build, but it will create either a contract asset or a contract liability, meaning the money is paid before the work is performed. These are basically like IOUs, or advance payments. As of June, their contract assets, the money that the company has earned but hasn't been paid yet, totaled about $7.3 million. Their contract liabilities, the money that they've been paid but haven't done the work yet, totaled about $5.1 million. Moving on, let's talk about related party transactions. These are deals that the company does with people who have close connections to the company, like directors. It is important to note a director of the company is also an owner of Cloud9 Support, which purchases materials from Urban-Gro, and Potco, which purchases equipment from the company for its cultivation facility. The revenue from these deals was pretty small, only about $3,300 for this most recent 3 months. However, it was around $400,000 last year. As of June, these related parties owed Urban-Gro about $400,000. Next up, prepaid expenses and other assets. This is basically stuff the company has already paid for but hasn't used up yet, like prepayments to vendors, insurance, and other fees. These totaled about $2.8 million. Property and equipment. This includes the computers, furniture, vehicles, software, and other equipment the company owns to run their business, with a total of $1.2 million. Investments. As of June, Urban-Gro doesn't have any investments. They used to have a convertible note, similar to a loan in another company, but they sold that off. Let's talk about goodwill and intangible assets. Goodwill, which is currently valued at almost $9.7 million. This is like the extra value that Urban-Gro paid when they bought other companies. Think of it as the value of their reputation and relationships, things you can't exactly touch or measure. Intangible assets, these are things that the company owns but aren't physical, like customer relationships, trademarks and trade names, and patents. Accrued expenses, this is expenses that they owe but haven't paid yet. They include money they owe for operating expenses, wages and related expenses, sales tax and interest of about $4.7 million. Notes payable is what Urban-Gro owes in terms of loans. As of June, it totals about $4.7 million. This includes a line of credit, which is at $4.5 million, and some other financing agreements. Urban-Gro also has operating lease liabilities. This is basically rent they have to pay for office space, which currently totals $1.8 million. This does not include equipment which was recently paid off. Here is an important thing to note: concentration risk. This means that a big chunk of Urban-Gro's business comes from just a few customers and vendors, and if they lose those customers or have problems with those vendors, it could hurt their business badly. The company is very reliant on the good graces of a select few of their customers. In addition to this, if their customers operate outside of the US, Urban-Gro faces foreign exchange risk. These are fluctuations between the US dollar, Canadian dollar, and euro. Stock-based compensation. The company uses stock options and restricted stock units, RSUs, to pay its employees and directors. These are basically ways of giving employees a stake in the company's success, but they also add to the company's expenses. The company authorized repurchases of common stock, but did not repurchase any this last year. The company has warrants, which allow investors to purchase the company's common stock. Urban-Gro has experienced losses for both accounting and tax purposes since the company's founding. Due to these losses, the potential for recovery of any tax assets that the company may be entitled to is uncertain. Looking ahead, the company took out a term loan for $2.1 million in October. A term loan is like taking out a mortgage. It's typically a longer-term agreement. They amended its line of credit in October to increase the requirements for the placement agent to earn additional payouts. The business has a couple of risks. They face concentration risk, with only a few customers making up a large portion of revenue, and that their auditor has identified material weakness, meaning the accounting may not be entirely reliable. Now let's put it all together. Urban-Gro is in a tough spot. They are in an emerging industry that is having problems. We may see the CEA industry bounce back. The fact that a growing percentage of their revenue has been shifted away from it is not encouraging. This is a business sector that has promise, but a lot of unfulfilled potential. The company has reduced costs, but has a long way to go. Their strength is that they are an established leader in what should be an emerging sector. But the weakness is that the emergence isn't coming quick enough, and they are saddled with liabilities. It is difficult to accurately give a bullish or bearish sentiment to this business due to many different outside influences that are unpredictable. At current, a share value of around 50 cents looks correct. However, the business is so risky due to the going concern, bankruptcy is a real possibility. This means the stock could be worthless. If I had to pick a direction, I would be slightly bearish, however, with a wide margin of error. Thanks for watching. If you found this helpful, please like and subscribe.